So take note that in absorption costing, here it's already the second case that our production exceeds sales. Our production exceeds sales. In here, production of 1,250 units, sales of only 1,000. And our guide rule is if production exceeds sales, the net income under absorption costing is higher than that under variable costing. So here we have now the cost of goods sold. It's lower by 4 pesos because our fixed factory overhead per month divide by the number of units actually produced. So now we have 1,250 units. So it's only at 16. It's no longer at 20. So meaning the 43 that we have in illustration 1 minus 4, that's only 39. The gross profit of 21,000. Then we deduct the variable marketing expense and the fixed marketing and admin expense, giving us the operating income of 7,750. Again, production exceeds sales. Net income is 7,750. On the other hand, if you have variable costing, again variable, and the guide is if production exceeds sales. Net income under absorption costing is higher than that under variable costing. So we have sales, we deduct cost of goods sold, only the variable cost, including direct materials, direct labor, and variable overhead. Now, take note that under absorption costing, our operating income is 7,750. Now, under variable costing, cost of goods sold is only at 23. That excludes the fixed factory overhead. Then we are going to deduct the marketing expense. We have the contribution margin. We deduct the fixed cost and the factory overhead and the marketing and admin expense. So we have the operating income of 3,750, which is lower than that under absorption costing because production is 1,250 and sales only 1,000. Okay, so we have now these computations under variable costing, and we have now net income. Again, it's a repetition. We compute for percent of sales by dividing each item by sales. So under absorption costing, still production exceeding sales, we have the operating income of 7,750. Since production of 1,250 exceeds sales of 1,000, meaning the net income under absorption costing is higher than that under variable costing. Okay, so be guided accordingly by our set of rules. Now, the net income compared for the two methods of costing. Okay, so we have the difference between the two methods of costing. It's 7,750 minus 3,750. Now we have the amount of 4,000. That's due to our remaining inventory since production is 1,250 and sales only 1,000. So in other words, there's an ending inventory of 250, and you multiply that by the fixed factory overhead of 16. So we now get the explanation for the $4,000 difference. Now, in that case, again, production exceeds sales. Okay, now the third guide is production is less than sales. So in this case, production is 1,250 and sales of 1,300. And be guided by our rule that if sales exceeds production or production is less than sales, then the net income under variable costing is higher than that under absorption costing. Okay, so again, we are going to determine the net income under absorption costing. So we have now for the sales of 3,000 units. Cost of goods sold still at 39 multiplied by 1,300 units. We have gross profit. We use the term gross profit for absorption costing. Then we deduct the variable marketing expense and the fixed marketing and admin expense. We have now the operating income under absorption costing equal to 13,675. But be guided accordingly by the last rule that if production is less than sales, net income under variable costing is higher than that under absorption costing. So under variable costing and under absorption costing, here we have the operating income of 13,675. Our cost of goods sold is at 39, leaving the gross profit of 27,300. Again, we have sold 1,300 units. The variable marketing expense is 1.25 per unit sold, and the fixed marketing and admin expense. So the operating income is 13,675. Under the variable costing, we have the operating income of 14,475. Thus, this abides with the rule that if production is less than sales, then the net income under variable costing is higher than that under absorption costing. So we have now the sales, we deduct the variable cost of goods sold and marketing expense. So the contribution margin of 46,475. Now we use the term contribution margin for variable costing. We deduct the fixed factory overhead and marketing and admin expense. We have the operating income of 14,475. Okay, now whereas in absorption costing, we have a lower amount of operating income. Okay, with the corresponding percentages. Since production is less than sales, now we have the difference in net income equal to $800. The variable costing net income is higher. Okay, for the difference. So we have 800 with the fixed cost of the previous months. 1,300 minus 1,250. We have an inventory difference of 50. Sales now is higher than production. So we have used 50 units taken from the previous month's production. At 16, the fixed factory overhead. That explains the difference of $800. Difference between the two methods of costing, the difference of $800. Okay, now we have this difference already explained. Cost of remaining inventory. Here we have 250 and 1,250. The current production, we deduct 1,300 units. So the inventory in units is 200 under absorption costing, it's at 39. Under variable costing, it's only at 23. So meaning there's a difference in the inventory values due to the items to be included or excluded. Okay, now the changes in inventory under absorption and variable costing. Now be reminded of these rules. I have given rules number 1, 2, and 3 in connection with absorption costing and variable costing net income. We are merely reviewing this because we have already taken this in chapter 10 of Van der Beek. Okay, so absorption costing or full costing approach to measuring profit is used for external financial reporting, assigns all manufacturing costs, direct materials, direct labor, variable overhead, and the share of fixed overhead to each unit of product. Used to calculate gross profit, operating income, and net income. This advantage format is not useful for decision making. Now, on the other hand, the variable costing approach, sometimes called direct costing, assigns only unit level variable manufacturing cost to the product. Costs include direct materials, direct labor, and variable overhead. Fixed factory overhead is treated as period cost, and it's not used for external reporting. As I've already mentioned, variable costing is used for internal use or management's use. Provides more useful information for management decision making. Limitations and ethics of profit measurement. Limitations focus is on past performance, difficulty of capturing all important factors in financial measures, ethics, people's desire to avoid losses, and their inclination to take a short-run perspective can affect the potential for unethical conduct. Apart from accounting profit, successful firms measure their impact on the community and employees. Okay, absorption costing, calculating inventory cost, and preparing the income statement. Now, I know that, again, this is just a repetition, so we will not stay long in here. Okay, under absorption costing. Now, we have the data provided, okay, and then we have now the income statement anyway, repeating only the previous slides. And variable costing, here we have your variable unit cost to exclude the fixed factory overhead. Then we have now the variable costing income statement. Here, production and sales are just equal. Next, we go to sales price and sales volume variances. So we have now your formula, the sales price variance, actual price minus expected price times the quantity sold. Sales volume variance, actual volume minus expected volume times the expected price. The overall sales variance, sales price variance plus sales volume variance. Variances are labeled favorable or unfavorable depending as to whether they increase or decrease profit. So we have now calculating sales price, sales volume, and the overall sales variance. The company distributes product in May. It expects to sell 20,000 pounds at an average price of 0.20 per pound. Actual results are 23,000 pounds sold at an average unit price of 19 cents per pound. Calculate the sales price and the sales volume variances for May and the overall variance. Explain why is it favorable or unfavorable. So we now have the sales price variance, the actual price minus the expected price times the quantity sold. So 0.19 minus 0.20 times 23,000, it's unfavorable because your price of 20, that's your expected price, is here higher, no? Because the actual price is 0.19 only. The expected is 20. So in other words, it's unfavorable because the expected price is higher and the actual price is lower. We are talking here about sales. Sales volume variance, actual volume 23,000, expected is 20,000 multiplied by 0.20. 0.20 is the actual, no, the expected price. So the variance is favorable because the actual volume is higher. The overall is taken by adding 230 unfavorable and 600 favorable. So the net variance is 370 favorable. Calculating sales price variance, sales volume, and overall. Overall sales variance is favorable because the favorable sales volume variance is larger than the unfavorable sales price variance. So meaning you are going to follow the sign of the item with the higher amount. Lower than expected sales price did reduce revenue, but the greater than expected volume overcame that effect and raised revenue overall. Now, calculating sales price, sales volume, and overall sales variances. Sales price variance, okay? I'm repeating, 230 unfavorable, 600 favorable, so the net is 370 favorable, okay? I hope you are following. Contribution margin variance, annual contribution margin minus the budgeted. So we have now your actual quantities sold minus the budgeted quantities sold times the budgeted average unit contribution margin. So the company produces and sells two types of bird feeders. Budgeted and actual data are given. Budgeted amounts we have for regular and deluxe model. We have the sales, and we have now the variable expenses and the contribution margin. So we have now the actual amounts for the regular model, and we have for the deluxe model, then we have the contribution margin for both now under the actual amounts. Actual contribution margins ng regular 5,000, sa deluxe 9,375. Amo ni ang aton nga budgeted. Okay, so calculate the contribution margin variance and volume variance and the budgeted average unit contribution margin. So the contribution margin variance, we have 14,375. That's the total minus 13,500. Okay, 14,375 and 13,500. So we now get 875 favorable. The margin volume variance is 1,250 plus 625 minus 15 plus 500 times 675. The variance is unfavorable. The budgeted average unit contribution margin with the formula, budgeted total contribution margin 13,500 minus the budgeted total units 1,500 plus 500. So we now get 6.75. For the sales mix variance, product 1 actual units minus budgeted Product 1 budgeted unit contribution margin minus budgeted average unit contribution margin plus product 2 actual units minus product 2 budgeted units times product 2 budgeted unit contribution margin minus the budgeted average unit contribution margin. So we now apply the formula giving us the variance of 1,718.75 is favorable. Now we go to market share and market size variances. So the market share variance, actual market share percentage minus the budgeted times the actual industry sales in units times the budgeted average unit contribution margin. So the market size variance, actual industry sales in units minus the budgeted industry sales in units times the budgeted market share percentage times the budgeted average unit contribution margin. Now take note of the formula. So we have now to calculate the market share variance and the market size variance if budgeted unit sales for the entire bird feeder industry were 20,000 for all model types. Actual is 23,000. So we now divide the actual market share of 1875 divided by 23,000 rounded off is 8.152%. The market share of 2,000 divided by 20,000 or 10%. And we have now the market share and the market size variance. So the market share, we have 2869 is unfavorable. The market size is 2025 favorable. Now we go to the product life cycle. We have the negative profit and the positive profit. So when it comes to maturity, from the negative profit. Now we have the impact of the product life cycle on cost management, product learning effects, setups, purchasing, marketing expense. Then we have the introduction, growth, maturity, and decline. For the product, the basic design, few models, some improvements, expanding product line, proliferation of product lines, extensive differentiation, minimal changes, reduced number of products. Okay, so will you take note of the impact, no? Itun-an nyo gini maayo, ha? Isa-isa. Impact. Product life cycle cost in ABC categories. We have unit level, batch, product level, facility level. So we have the product life cycle. Okay, all of these have high product life cycle. Product life. Okay. Okay. Class, anyway, I will post this, screen share, and I have recorded this, so you can open the YouTube for this. Okay, open the YouTube, kay naka-record ini sa YouTube from the beginning up to the end. Now, for your assignment, for tomorrow, will you take the following for your assignments, exercises, number 1, chapter 2, ha? Exercise 2-1, 2-2, 2-3, 2-5, 2-6, 2-8, 2-9, 2-10, 2-11, 2-13, 2-17, 2-19, 2-20. Okay. Amo lang na anay. Daw kadamo-damo pa man na. So anyway, let's start with this tomorrow. Okay? So shall we now, Miss Hanagap? Shall we have the closing prayer to be led by you?
Excuse me, ma'am.
Oh, ano?
Ma'am, excuse me, ma'am.
Ano?
May question ko, ma'am, about sa book. Ang about sa book, bala, ma'am.
Oo.
Ang sa e-book.
Oo.
Ang san, pwede, san,
Nagkapila na ko nag-text, kagaina, nag-text ko liwat, kalima na. Kaya ang balya lantaw niya. Siguro, amo na ang ilang nga reaksyon, kay man, anom lang ka students ang nag-order. So, anom lang. Siguro, nang daw alang-alang, way ko kabalo, kay ang balya, sabto niya man ko kaina, ti wala man ka sabat. Anyway, tomorrow, mambalang ko, kung anong sabat niya. Kaya nga akong duda, kay anom lang ang nag-order, ti ba hindi sila kay gamay. Oo, amo na nga ton nga problema. Anom lang kamo mo. Ti buwas mambal naman ko. Text ang kuliwat. Ha? At sige.
Okay, ma'am. Inform mo lang kami, ma'am.
Oo. Miss Hanaga, plead anay.
Ma'am.
Oo, sige na.
In the name of the Father, and of the Son, and of the Holy Spirit. Dear Lord, the giver of all things, thank you for all the blessing you bestowed upon us. Thank you for the opportunity to have this class, and may you continue to bless us with your graces. Amen.
Thank you. Miss?
Thank you, ma'am. Bye-bye. God bless.
Bye.
Thank you, ma'am.